Hey guys, welcome in this video. I hope that all of you are doing right. So in today's video, we will talk about the stock market and we will look at what is coming for the overall markets in the next couple of weeks and even the next couple of months. So I'm really going to share with you guys a lot of value. I think that this video is going to be just amazing. I was really excited to record it and I want you guys to stay until the end of the video because otherwise everything that I will say will not really make any sense if you don't watch the whole video. So it's really important and I will try to make everything as simple as I can so that all of you guys can really understand the message of this video and just learn something from it, right? So just before that we start, as always guys, feel free to drop a like on the video. I would really appreciate it and it really helps me grow the channel even more, and make sure that you are subscribed as well if it's not already done. All right, so let's get into it. I have a few different points written here just to make sure that I don't forget anything that I want to share with you guys. So first of all, let's look at the S&P, right? So the stock market, and let's just do a very simple technical and fundamental analysis just to understand a bit where we're at on the markets right now, okay? So essentially, right, what we had is that here in 2020 and 2021, we had a big up move on the stock market. So we had a big bull market that I think everyone knows. And at the beginning of 2022, we actually started a much bigger correction, as you guys can see, and we are still within this correction at the time being, okay? And so the first thing that is really interesting to notice when it comes to the chart here in itself is that this correction has been defined very, very nicely with this trend line right here and this moving average. Okay, so I have a trend line here and I have a 200 moving average, and as you guys can see, it's really been respected nicely for now. And in terms of technicals, okay, that's really the main level to watch. Now, one thing that is important to understand is that, as you guys can see, even this week, the market tried to break to the upside, but it was not really able to keep going and to make a big move. And the reason why is simply because we also have pretty big horizontal levels that are not really far from it. And so I think it's important to wait for one of these breaks to really confirm the next potential move when it comes to the chart, right? And so as you guys can see, for the upside, we have the 4,100 level right here, which has been respected very nicely. And for the downside, we have the 3,900 level, which also has been respected pretty nicely. And so we are in kind of a zone here that is mixed in the sense that it could either break to the downside or to the downside. I think that the two possibilities really do exist. And so in this video, I'm going to try to give you guys a better idea of what can cause the break to the upside or the break to the downside so that you guys will know what to look for after that on the markets. All right. Now, in terms of fundamentals, okay, just to make it simple, essentially, right, what we've seen is that for multiple months now, the Fed has been raising interest rates, okay? And so the fact of raising interest rate actually is something that tends to slow down the economy and tends to be negative for the stock market. So that's the main reason why we have been in a big correction like this. And the reason why they have started to raise interest rates is simply because inflation was very, very high and they needed to lower inflation because this was a big risk for the economy, okay? And so essentially, that's the reason why we have been in this really big correction on the stock market, okay? And so what we will need to watch is essentially, okay, well, what will happen with interest rates and what will happen with inflation, and this will already give us a better idea of what the markets could do, okay? Now, the first thing that will be important to pay close attention to is what we will have at the beginning of February, so about a week from when I'm recording this video. And as you guys can see, so the 1st of February, we will have the decision for the interest rate from the Fed and the press conference, okay? So this will be at 2 p.m. and 2:30 p.m. Eastern time for the conference on Wednesday, the 1st of February, right? And so what will be important here to watch is not really the interest rates themselves, because we know almost at 100% that the Fed wants to hike interest rate by 25%. I mean, 25 basis points, sorry, not 25%, okay? So 0.25% or 25 basis point, it's the same thing, right? The reason why we know this information is simply because in the last couple of weeks, we had a lot of different Fed members that simply came out and they essentially said us that, you know, this is what they were planning to do. So they don't want to hike too aggressively for now. And that's the reason why they're planning to do this, right? So when they will hike by 0.25%, it's not really going to be a surprise to the market. It is going to be something that everyone expected, and it's not really going to move anything. Okay, so this will be for the interest rate, but what will be important, okay, will be the press conference right here that we will have after this. Okay, and essentially, right, we will have the Federal Reserve Chair, so Jerome Powell right here, that will come out and he will basically talk about, well, their decision and the monetary policy, and they will answer questions and stuff like that. And what will be interesting to watch is essentially what they say relative to interest rate and inflation, right? And essentially there are really two main points of what they could talk about and how I think it could develop, right? So the first possibility is that if the Fed comes out and say, for example, that, okay, inflation has been going down, we are getting closer to our goals, so we will eventually pause raising interest rates and slow it down, okay? If they say something like this could be interpreted as something being positive for the market, and this could actually lead to a breakout to the upside, maybe to go to 4,100 and maybe even more. Okay, so this would be one possible scenario of how the Fed could impact positively the market. Now the other way around is just as possible, right? So for example, if the Fed comes out and they say that yes, inflation has started to come back down, but we are still very far from our goal, we still want to keep interest rates very high, we're not thinking of pausing right now, blah blah blah, right? All of these things, well, this will be more negative for the stock market, and I think that we could definitely go back to 3,900 and most likely I think break this level and probably go back to this one here. Okay, so these are essentially the two main scenarios when it comes to the Fed next week that we will have to watch, and that will give us an idea of how the markets can develop for, I would say, the short term. Okay, so for the next couple of days or maybe a couple of weeks. Okay, so that's essentially the short-term analysis right here. Now, what I also wanted to show you guys in this video is more of a longer-term view, and you will see that it will get very, very interesting. And that's the reason why I said that it's important to watch until the end of the video so that you understand all of these things, okay? Now, look at what we have here, okay? So I'm going to try to make it as simple as possible for you guys because it can get pretty complex, I think, pretty fast, okay? So if we look, first of all, at this chart right here. So what is this chart, okay? So here I took the 10-year yields in the US and I actually did a comparison with the 2-year yields, okay? And this is giving us this chart right here. It's giving us this line, okay? And so this is what we call a advance indicator, that when we have the flip, okay, so when it goes from positive to negative, so when you know, the 10-year and the 2-year have an inversion, essentially, this is a sign of a potential recession. Okay, so this is a pretty well-known indicator, and it is something that is quite powerful. And the reason why it's quite powerful is simply because if we look at history, okay, we've seen that it worked multiple times pretty nicely. Okay, now it didn't work 100% of the time, so it's not a perfect indicator because, again, there is nothing perfect on the markets, right? There are always indicators that will work and sometimes they don't, right? I mean, it's just part of it, but it's a very good indicator, and it can really give a good idea of what we can expect in terms of probabilities for the market. Okay, and so this is the line that I have right here. This horizontal line is the 0 line, so the inversion level, and the white rectangles that I have right here are the recession periods. Okay, and the first thing that we have to notice right here is that we have a inversion, and sometime after that we start the recession. Okay, and I would say that on average it's between 12 to 16 months. Okay, so a year to a year and a half approximately. That's normally how long it takes between the inversion and the beginning of the recession. Okay, so it did happen right here around 1990. It also happened around 2000. We had a inversion right here, and sometime after that we had the beginning of the recession. Same thing right here, okay, exactly the same situation. Now for this one, it was a bit different because this was the crisis, right, related to the pandemic and stuff like that. So it's a very special event, right? It's not the normal kind of recessions that we would see. So it didn't really happen because here we didn't really have an inversion, but we were pretty close to it, as you guys can see. Okay, and right now, well, as you guys can see, we are really negative and we are very much under 0, and so this is giving us a sign that we are potentially going going to get into a recession. Now, again, it's not 100% sure, but it's a pretty good overall indication that this is very likely to happen, okay? So that's the first thing that we need to keep in mind, is that the inversion happens about 1 year to 1.5 years before the actual recession starts, okay? Now, what I want to show you guys as well is that right now I'm going to add, first of all, the US interest rates. So the orange line that I have right here on the chart is the interest rates. And then what I will also add right here is the S&P, so the stock market, right? And what is really interesting here, okay, and follow along with me here, you'll see, I know it looks a bit complex, but it's really not that complex. What is really interesting is to notice the link between the inversion as to when the Fed actually paused raising interest rate. But what is really interesting here is that a lot of people think that when the Fed pause interest rate, or that they start to cut interest rate, it means that the markets are automatically going to burst through the upside and they're going to make a massive move, okay? But in reality, it's really not how it works, okay? And I will show you guys this on that chart, okay? So essentially, right, let me break it down to you. So the idea, okay, is that we get the inversion. That's the first thing, okay? Now, for example, here at the same time, if we look at the interest rate, we can see that we had a pause right here of interest rates. So interest rates were going up, and here it made a pause. And as I said, a lot of people think that when we have a pause in terms of interest rate, all of a sudden markets go up, okay? But if we look at the stock market, what we will notice is that we had a big correction, but this correction actually came after that, okay? So if we'll use a vertical line, okay, and we just put the line, for example, at the beginning of the pause right here of interest rate, we can see that the market actually took quite a long time before making a bigger correction, right? So just because we are pausing interest rate, or just because that the Fed is starting to cut interest rate, does not mean that the correction is over, okay? It could actually mean that we could still be in a correction if we just look at this indicator, right? Even when they started to cut interest rate, look at the vertical line, right? Even right here, they already were cutting interest rate and we were still just starting to make the bigger correction, right? So, you know, for them to pause interest rate does not mean that it's necessarily the low, okay? So that's really important to understand. So this was the first example, and we will do this one and this one here, and you guys will see it's just as interesting, right? So again, let's keep on going with the same mentality. So first of all, if we look at the yield curve, we have the inversion right here. If we look at interest rate, we can see that it actually made a pause right here. We can see that around the same time, here is when the market actually started to go down. But again, look at the low point, right? Look at the moment at which it made the low after the crash before going back up. It's right here. Okay, so look at how far it is actually from when we had a pause in interest rate. So we had the inversion, interest rates made a pause, they started to cut interest rate, and it took quite a long time before that the market was feeling better about it and that it started to go back up. So again, there is a delay right here, and we will see the same thing around 2008 right here. Inversion of the yield curve, interest rates making a stop right here. And we can see that the market actually started to go down a bit after that. Okay, so this was the high. They were already cutting interest rates right here, and it made a low much later on. Okay, and so if we kind of apply the same thinking to what we have right now, well, even if interest rates start to pause right here, okay, well, we do have the inversion, interest rate could pause, but maybe that the market could make eventually a bigger correction and start to turn much later on if we follow the past right here, okay? So this is a really, really important chart to understand. If you didn't fully understand, rewatch this part of the video. I'm telling you, it's really, really important, and it is a really good indicator to have, okay? So that's about it. So all of this to say that just because the Fed is going to pause interest rate does not necessarily mean that we are turning for the long term, right? As I said, if they do talk about pausing and stuff like that, it could on the short term give a little boost to the market, maybe go all the way to 4,100 or even this level right here. But is it really going to be the event that pushes the market to all-time high and give us a big move? I don't think so, okay? So that is extremely important to understand, and I think that it's probably one of the main ideas to have in mind right now, okay? Now, the last point for this video that I want to share with you guys, because I don't want to make it too long or too complicated, as I said, is essentially what's going on with China, okay? So China is reopening, okay, to the world because they have been in a pretty long lockdown because of their policy related to the health crisis that they had. And essentially, right, if China is reopening, one of the things that this could lead to happen on the market is simply more demand for commodities. And this could lead to commodities going up. We're already kind of seeing this right now on the market. And if commodities do go up, this could actually impact inflation, okay? So let me show you guys, for example, this chart right here. So this is a chart of the oil prices and inflation, okay? And first of all, what we can notice is that, well, the cycles between oil and inflation are very similar, okay? They're kind of following each other. Now, one thing that is important here to understand is that oil is the leading indicator and not inflation, okay? Oil has an impact on inflation, not the other way around. So if oil, for example, goes back up because China is reopening, I mean, eventually, potentially, right, this could lead to more inflation. So that is a big risk, I think, for the market that a lot of people are not seeing right now. So I'm giving you guys here a big piece of value, okay? Because a lot of people are not thinking about these things right now, but it's really, really important, I believe. And it's the same thing, for example, with copper, okay? So copper is another commodity. So look at this, right? In orange, we have the CPI, which is, again, the inflation metrics. And then in black, we have copper. And so the cycles are pretty much the same, as you guys can see. And so if we look at these two markets, which are really the two main commodity to have a better idea of what can happen with inflation, I mean, let's look at oil. As you guys can see, oil is still fairly low, right? It didn't go back up much, but we have a big horizontal level right here. And if we do get this break at some point, I mean, it could start running and oil would go back up. And then if we look at copper, look at this. Copper is already back up pretty nicely, okay? And so one of the risks that we have right now on the market is that China reopens, more demand for commodities go up. This feeds into inflation. And if inflation goes back up, the Fed will have no choice but to raise even more interest rates, and this could be very, very, very negative for the stock market, okay? So let's just do a very quick recap just to make sure that you guys understand. So essentially, on the short term, okay, we could probably get a break either way, okay? If we look at this chart right here, it mostly depends on what the Fed says, but even if we break to the upside, it's not necessarily a long-term confirmation. If we break to the downside, we could definitely make a bigger correction, okay? So we'll see which of these scenarios happen. So as I said, first of all, we will need to watch the Fed, then get the technical confirmation of the breakout. But again, this will be more of a short to medium term move. I don't think that this will be a long-term move because of all of the other elements that I showed you guys. And these will be the things to keep an eye on to have a better idea going forward into 2023 of how things can develop. So that's about it. That's a video. That's what I wanted to share with you guys. I hope I was able to make everything clear. As I said, I try to keep it simple because I want everyone to understand, right? But I still hope that I was able to bring you guys a lot of value. If you found this video interesting, as I said, leave it a like. You can also share it with other people if you think that this could help them. And on that, well, simply take care, try to do care, and manage your money well. And I will see you in my next video. Bye-bye.